I use a price to sales ratio for Amazon, and I was thinking about it. Does that accurately reflect the company? Because it doesn't really.
Okay, folks, let's get started. Where is everybody? Checked out already? Okay, I have the remaining quizzes I brought into my office this morning because I'm going to put out the corporate finance quizzes, and I'm always afraid that the two will get mixed up. So if you haven't picked up your quiz, I'll put it out again after class today. For the rest of today, it should be okay, but tomorrow I will take it back in. So check at 3 o'clock. Give me 5 minutes to get up to my office, and I'll put it out. Okay, so let's continue today with real options, and we'll actually finish the session. But I want to start with the test on this notion of natural resource options. Remember we talked about this last session? You have undeveloped reserves. You own those reserves. You have the right to develop those reserves, not the obligation. So there's an optionality. So I'm going to build on that with today's example. So what I'm going to do first is I'm going to show you two companies, and actually I should change the example because Petrobras immediately other things come to mind. But let's assume we have two companies which have the same value as companies. So the enterprise value is the same, but where they get the value is different. So let's say Royal Dutch gets most of its value from developed reserves, and Petrobras gets a big chunk of its value from undeveloped reserves. Okay, so far so good. So you have the enterprise value for both companies, you do a discounted cash flow valuation, you value both companies. Then you try something. Right? Let's assume there's a crisis. The prices all have to be updated as well, but kind of hang in there and act like the prices are reasonable. Let's say the prices jump from $80 a barrel to $160 a barrel. Don't ask me what the crisis is. Oil prices have jumped. So the first question is, what will happen to the values of both companies? They both go up, right? That was easy. Oil prices go up, both. Now let's assume the day after the crisis passes and the oil price drops back to $80 a barrel. So at 80, 160 back to 80. It's almost like it didn't even happen. Except it did happen, and you remember it did happen, but the price is back. What will happen to the market caps of the two companies? You see what my question is? You value the companies at an $80 oil price 2 days ago. Yesterday the price jumped to 160 and you told me the value was higher. Now the price is back to 80. Will the value revert back to what it was? And I'll give you the choice. Will it revert back to what it was 2 days ago? Will this crisis in some way have affected the relative valuations of the two companies? And if so, which one's going to be worth more now? Yes, G.
I think the company that, I forget which one.
Petrobras.
That got more
Reserve.
Undeveloped reserves.
Will,
Worth more.
and what is it that will make it worth more?
The expected value of the optionality is higher.
And basically, variance is an implied number, right? We don't look at historical variances. It's a perception. So if you have a crisis, what happens? Your perception of future variance goes up. And when your perception of future variance goes up, the value of those undeveloped reserves increases. So effectively, that's basically the point I was trying to make, is when you look at a natural resource company, it's not just the level of the price you should be looking at, but the variance in that price, because the level affects the value, but the variance affects the optionality. So if there's any hope for Petrobras, that's where it lies, right? You're hoping oil prices go up. That's obviously one way in which Petrobras can get out of its troubles. The other is maybe the variance will go up so much. I mean, we're seeing Saudi Arabia and Yemen. Who knows what the next effect? Maybe Saudi Arabia and Iran will get into something. Let's hope not. But if it does, I mean, that could be Petrobras' salvation. Is some geographical catastrophe somewhere else that pushes up oil prices and makes them more volatile. So that's basically a simple way to think about it. One final point. Petrobras is talking about selling stuff now because they have $135 billion in debt. And for them, the most valuable stuff they have is their undeveloped reserves. So let's say you're ExxonMobil. I mean, hitherto, Petrobras has been restricted from selling reserves because it's a national interest. They don't want you to sell, but now they're desperate. So let's say that you're ExxonMobil, Petrobras is willing to sell you its reserves with one restriction. That if the oil price exceeds 150, you have to turn over whatever you make above $150 a barrel back to the government. So when you buy those undeveloped reserves, you're buying a call option, right? With the call option with a strike price, just like we did, so we can value the call option. But I've now introduced this cap. First, will this cap reduce the value of what you're willing to pay or increase the value? It'll reduce the value because I've capped your profits. You know how I'd value the cap? It's actually a tool that's very useful anytime you deal with options. Is how do I value a capped option?
Just like a strata, basically. It's like
In terms of mechanics, tell me what I'd do. I'd actually have to value two call options. Here are the two call options. In fact, here's the way to think about my payoff diagram. I basically have a regular call option, but once I get to 150, what happens? It gets capped off. To value a cap call option, here's what I would do. I'd value a call option with my regular strike price, then I'd value a call option with a strike price of 150. And the difference between those two numbers is going to give me the value of a cap call. It's a very, very useful technique to remember, because often you will see these options with a restriction on how much you can make on the upside. This allows you to value the restriction. So all related to the natural resource options. Any questions at all about natural resource options? If any of you are working with natural resource companies, it's very difficult to put this option into practice because what is it you will not be able to get for an oil company to be able to use these? What are the inputs you need to value undeveloped reserves as an option? First, you need to know how many barrels of oil you have as undeveloped reserves, right? There's already a problem. You know what oil companies are required to report? Not all reserves, but only proven and actually almost viable reserves, right? Which means that they have to report only their in the money options, not out of the money options. So first problem you're going to run into is getting all those reserves. Second, you have to get a sense of what the cost of developing those reserves is, because that's what becomes your strike price. This is something that you can do from within the company. It's much more difficult to do from without the company, from looking at a company from the outside. Okay, so let's go back to the notes, because there's one more option in projects that I want to deal with before we kind of put that to rest. Almost every real option you run into is a call option. The option to delay is a call option. A patent is a call option. Undeveloped reserves is a call option. There's only one real option that you will run into that's a put option. It's called the option to abandon. Sounds fancy, right? You know what the option to abandon is? You get into an investment, you learn early on that things are not going to work out. It's nice to be able to walk away from that investment, right? Let's assume you know what you will make if you walk away. So you own a piece of land, you've built a factory on it, but if you walk away, you can sell the land and you will get $10 million. Well below what you paid for the factory, but that's your abandonment value. Now obviously you wouldn't abandon your factory if the present value of the cash flows from continuing exceed 10 million. But if it drops below 10 million, here's what you're going to do. You're going to abandon the investment, collect your 10 million, and walk away. That's an option to abandon. So I'll take a very simple example of an option to abandon. For some reason it's not working. Okay. So let me give you a very simple example of an option to abandon. Let's say that I'm Airbus and you're Lear Aircraft. Lear historically has produced corporate jets. They haven't produced passenger aircraft. Let's say you as Lear Aircraft are very interested in producing some small passenger jets and you don't have the expertise, so you come to me for a joint venture. So you're going to put in $500 million. I'm going to put in $500 million. And you really want me as your joint venture partner. So I'm Airbus. I work through the numbers. Based on my projected cash flows in this joint venture, the present value of the cash flows I see from this investment is only $480 million. So already what have I told you? From my perspective, it doesn't make sense for me to join in because it cost me $500 to be part of the joint venture and I think I can make back only $480. So I say, no, I'm not interested. But remember, you really, really want me as a partner? So you come back with a counter offer. You say, look, if you decide to become my joint venture, so you are Lear and I'm Airbus, I'll give you the right to walk away from this investment any time over the next 5 years and pay you $400 million to go away. Less than what you invested, but what have I done? I put a floor on how much you can lose. You can't lose more than $100 million. I've given you the option to abandon. So let's see how much that option is worth. Do you see why you want to estimate that? Because if that option is worth more than 20 million, your project goes from being a negative net present value project to a positive net present value project. So here's how I'm going to estimate the value of the put option. I'll give you a couple of other pieces of information. That present value that you got of 480 million is the value today, but it could vary across time. Let's say the standard deviation in that value, the variance in that value is 0.16. The standard deviation is 0.4. So there's a lot of uncertainty about the value. And second, the project itself has a life of 30 years. Which means each year you go in, the project is going to get less valuable over time simply because you have fewer years of cash flows left in the project. So here's what the output looks like for the option. The value of the underlying asset is the present value of the cash flows from taking the project today, which is the 480 million. The strike price is what you will pay me if I abandon the project, the 400 million. So it's a put option. It's an out of the money put option because the strike price is less than the stock price. The variance in the underlying asset is 0.16. So that's what's going to create the value of the option. Is the 480 could become 320 or 240 or 150, in which case I'm going to abandon this project and walk away. I give you the rights to do this only for 5 years. You see why I have to do it only for 5 years? If I gave you the right to abandon any time over the next 30 years, you know what you're going to do? You're going to be my partner for 29 years and 364 days, and the very last day you're going to pop up and say, I never liked this project. Just pay me 400 million. So if you're going to give an option to abandon to somebody, just have the sense to make it a much shorter life than the life of the project. And each year you continue with this project, there is going to be a loss in value because it's going to become a 30-year, it will become a 29-year, 28-year, 27-year, 26-year, 25-year project. The cost of delay I've just estimated is 1 over the remaining life of the project. If you have the actual cash flow, you can use that instead, and the riskless rate is 6%. Yes?
Would it be more advantageous for, sorry, I don't know
Yeah.
who was making the,
So you are Lear and I am Airbus.
okay,
So-
would it be more advantageous to offer an option that lasts 30 years but give them 20 million so that they just, at the worst case scenario, they break even?
If you give them 20 million, so you could value the put. It might be worth close to nothing, to be quite honest, right?
Okay.
Because you see, remember, you want to get me as a partner. That's why you're trying to sweeten the pot. This is not about what's the lowest cost option you can give. It's really about offering an option that's enough value to me that I'm willing to become your joint venture partner. And it's got to have a net present. The value of the option has to be greater than 20 million. Not just that abandonment value. The value of the option itself has to be greater than 20 million.
Okay, but if you can value it, say you figure out like 30 million, a 30-year option that
With a strike price of 20 million, you could do that. I don't think it's going to be worth very much because that's got to mean the 480's got to go to 20, and even with the standard deviation I've given, it might not get there over 30 years. So I might say I don't care because that means I lose most of my 500 million anyway. That's like getting nothing, right? So that's basically what I've done here. I put the numbers in. The value that I get for the put option is about 73.23 million. So think of what you've done. The project that I was looking at a negative net present value of 20 million, right? I wasn't willing to be a joint venture partner. You've now sweetened the pot by giving me the option to abandon. And because I have the option to abandon, which is worth 73.23 million, I'm willing to be a joint venture partner. The only catch is you've given away an option worth 73.23 million, right? So for this to make sense for you, what has to be true? It's not just the option. The value of the project to you on your 500 million better be worth more than 73.23 million for you to be giving away this stuff. It's easy to entice other people to be your partners, your customers, by giving them flexibility. That's why you never let a salesperson negotiate terms for you, because if they want to sell things, they're going to give it, oh, you want to get out? Not a problem. You want to build in that option? Not a big deal. Because they want to sell stuff, but those options you pay for as the person giving those options. So that's what you have to check to make sure you're okay with. Because the deal still has to have, so your net present value must have been greater than 73.23 million for you to offer me this deal to entice me to become part of this joint venture. Any questions? Yes?
Yeah, so just to that last
Yeah.
point, like the reason these two parties might have agreed to this is because like, is it possible like the PV of the cash flows that one party
Yep.
estimated was higher or
Than the other.
or-
Exactly. So in this case, Lear actually was getting a much bigger positive present value from running this joint venture, and they're therefore able to give you some of their present value to entice you to become
or your
a partner in the deal.
expected variance is lower.
Or the expected. So it could be differences in the way they look at the same project. So it's an interesting way to think about flexibility, right? Because we talk about why some companies are worth more than others, and there's an argument that companies that are more flexible in the sense that they can respond to bad times by cutting back much more quickly, should be worth more than companies that are inflexible. It's one way to think about it. That company has in fact has an option embedded in its value. I mean, when Goldman was at its peak, this was its mystique, right? Mystique in what sense? When bad things happen, they always seem to get out about 3 months before everybody else did. When good things happen, they always manage to take that good thing and build on. In other words, they had call options on the upside and put options on the downside. Of course, if you're cynical, you might say that's because the U.S. Treasury is run by a Goldman guy and maybe you're getting advance information. So you can have any story you want, but that's really what you're thinking about in terms of building flexibility. So when you think about building flexibility into your decision making, you're really talking about options, put options that you're getting so that in case things don't go well, you get a chance to walk away. And that's worth a lot, especially if you have a lot of uncertainty about the future. Final aspect of this section is I want to talk about options and capital structure. How many of you were in my corporate finance class? Okay. Just a few, but we in the corporate finance class we do optimal capital structure. We talk about what the right debt ratio for a company is, where the point at the cost of capital is minimized, and at the end of the class, you know, we have about 350 people in the class, everybody does their optimal capital structure, and we do a show of hands of how many companies have less than optimal debt ratios and how many have more than optimal debt ratios. I think almost every time I've taught this class, 80% of companies come in as under-levered. Some by big chunks. So the optimum will be 40%, the company would stop at 5 or 10. And I've been doing this for a long time, but when I first started doing this, here's what would happen. I'd do this for a company, I'd say your optimal debt ratio is 30%, you have only 0%, you have 5%, you should borrow more. And they say we cannot. So why? Say because we value financial flexibility. And it used to drive me crazy. Because those words sound so good, right? Everybody wants financial flexibility. So I started digging a little deeper. Financial flexibility to do what? And it turns out that companies set aside or hold back on debt capacity either because they're worried about something bad happening and they want to draw on their debt capacity to survive, or in case they get that investment opportunity of a lifetime. You know what I mean by it? So an acquisition, a great project comes along, they say, look, if we have excess debt capacity, we're going to be able to take the project. I'm going to use that insight to try to decide what the value of financial flexibility is. I'm going to value it as an option. Do you see what the option is? You get the option to take a project because you have excess debt capacity. And if you did not have that debt capacity, you might not have taken the project. So in terms of the setup, what's driving this is the assumption that if you did not have excess debt capacity, you might not be able to raise the capital to take that project. And because you have debt capacity, you're able to take the project. So here's what the payoff diagram looks like. Let's assume that there's a certain amount of money you can raise as a company through the normal access to capital. So this is your operating, so your debt capacity, letters of credit. So let's say there's a certain amount of money. If an investment shows up that requires more than that amount of money, here's what having excess debt capacity allows you to do. It allows you to take that investment because you have under-levered yourself. So the call option is that you get to take projects you otherwise wouldn't have been able to take because you have excess debt capacity. But remember, the value of a project is not just that you take it, but that you earn more than your cost of capital. So if you think about the value created from that excess debt capacity, it's those great projects you're now able to take because you had debt capacity set aside. So you set aside debt capacity hoping great projects come along. What if they don't come along? What's the cost of this option? What does it mean to be under-levered? Your cost of capital is higher than it would have been otherwise, right? That becomes the cost of the option. So by being under-levered, what you have is a cost of capital that's higher than it should be, but you're okay with it because it allows you to take these great projects in the future. The question is, can we actually put a number on this? So I'm going to try. I'm going to take a company that I actually use in my corporate finance class, and this is actually from my 1997 edition of my Applied Corporate Finance book. Company I use is Disney. And in 1997, their actual debt ratio was 18%, their optimal debt ratio was 40%. Optimal in what sense? At their 18% debt ratio, the cost of capital is 12.22%. If they go to a 40% debt ratio, I think their cost of capital will drop to 11.64%. So by being under-levered, their cost of capital is 48 basis points higher than it should be, right? But let's say they say, look, we need this because we value financial flexibility. I'm going to try to value financial flexibility on an annual basis, and here's why. If the value of financial flexibility is greater than 48 basis points a year, then Disney is right not to borrow the money. If the value of financial flexibility is less than 48 basis points a year, Disney should go ahead and borrow the money anyway because the value of flexibility is not that great. So it's kind of messy, but hang in there if you can. To value financial flexibility, here are the inputs I need. I need to know what the reinvestment needs are on an annual basis. And that wasn't difficult. I went back and looked at capex and depreciation and working capital over time. And their average reinvestment, so net capex plus change in working capital divided by value, was about 5.3% a year. So I took 5 years of data, and the average across the 5 years was 5.3%. Then I looked at the variance in that number, because the variance is what drives my uncertainty. I don't know whether it will be 5.3%, 7%, 9%, or 1%. The variance in that number over the last 5 years was 0.375. So there's a lot of uncertainty about what the reinvestment will be in the future. for the K, which is the strike price, I looked at what they normally access in the capital market, and they do some normal borrowing every year, and that amount over the last 5 years was 4.8%. So that's what they can raise even if they had no debt capacity. So you can see already that they can raise less than their typical reinvestment need. They have a deficit already, and if there's uncertainty about the reinvestment, that deficit could be a much bigger number, and that's where having the excess debt capacity is going to help them. And I'm going to measure the value of this option over 1 year. So I plug the numbers in. The value that I got for this option is 1.61%, but that's the option to actually take a project. So by having excess debt capacity, Disney has an option that is a value of 1.61%, but that option is going to add value to the firm only if projects earn more than their cost of capital. So in the case of Disney, here's the final piece of the puzzle. They were actually, at the time that I did this, earning a return on capital of about 18.69% on their projects. Their cost of capital was 12.22%. They're making 6.5% more than their cost of capital. If I make the assumption that's what they will make on this new project that comes along, the value of the option, financial flexibility, is the 1.6092% that I got with the option inputs from the previous page, multiplied by the excess value created by this project. So the numerator is my excess returns, my denominator is, so that's like a present value of a perpetuity. The value that I get for financial flexibility on an annual basis is 0.85%. So let's back up. Disney is under levered, right? Its cost of capital is 48 basis points. Is that what it was? I think it was 48. 58 basis points higher than it should be, 12.22 versus 11.64%. But in return for having this excess debt capacity, the value of flexibility they're getting is 0.85%. So based on that comparison, you know what I'd conclude? Disney is under-levered, but it's okay. They should stay under-levered because the value of flexibility is greater than the cost of keeping that flexibility. Yeah.
Since you said that they were withholding this from like a deal of a lifetime, would you assume that the excess return that they could earn on these projects might be higher than their typical excess return?
You could. In fact, lots of assumptions you can make. In fact, what's this value of flexibility rest on? What's a key assumption? I restricted them to 4.8% of value, right? Why are they restricted? Disney is a big, large market cap company. You know why they're restricted? Because most companies don't like to issue new shares. What's dilution effect, whatever. So partly this is almost an artificial value to begin with. If they can raise capital, they can issue new shares. You know what's going to happen to the value of flexibility? If K starts to go towards infinity, which is what you have with access to capital, the value of the option goes to zero. If the value of excess returns, I thought you were going to go in the other direction. Deal of a lifetime, there are a lot of people bidding for that deal, that the excess returns actually are going to decrease rather than increase. If the excess returns go towards zero, the value of flexibility goes to zero. I don't think you will ever in your lifetime have to value flexibility in terms of numbers, but understanding this process will tell you what kinds of firms are most likely to value having excess debt capacity. In fact, let's flesh that out. If you think about the three factors that drive what kinds of firms will value financial flexibility, here's the first one. The more capital constrained you are as a company, the more you will value financial flexibility. You see why? If you have no capital constraints, if I remove that entirely, the value of the option goes to zero, because if you can raise as much capital as you want anytime you want, you don't need to have excess debt capacity. So the more capital constrained you are, the more you're going to value flexibility. Put differently, I would expect small companies to be more under-levered than large companies. I'd expect companies in developed markets to be more under-levered than companies in emerging markets to be more under-levered than companies in developed markets. Do you see why? If you're in an emerging market, you're capital constrained. You have to have the capacity set aside or you will not be able to take those projects. In fact, those companies might, instead of borrowing 30%, might borrow 20 or 10 or 5 or 0, or they can keep going. They can actually, how can you have a negative debt ratio? What do you do if you don't want to borrow money? What can you keep doing if you want to build up flexibility? Or accumulate cash. The net debt ratio can be negative, and if you're really terrified of how much capital constraints you face, you value flexibility so much, you're not just not going to borrow money, you're going to accumulate cash in the company. because by accumulating cash, you're getting the option to take all those projects that other people will not be able to touch in the middle of a crisis. So that's the first. Second, the more unpredictable your reinvestment needs are, the more you will value flexibility. It's an option, right? So if you're in a business where you know exactly what your costs are going to be for the next 25 years, Con Ed, for instance, their capital expenditures laid out on paper, and they pretty much stick to it because they know exactly what they're going to spend and when they're going to spend it. Google has no idea. If you're a technology firm, you have no idea what you're going to be reinvesting in 3 months from now. So the more uncertain you are about your future reinvestment needs, the more you will value flexibility. And third, everything rests on your capacity to earn excess returns. If you're a GM, don't even talk to me about the value of financial flexibility. I don't want you to have any flexibility because what are you going to do with it? Take more bad projects? So if you're in a business with great excess returns, you should value financial flexibility a great deal more than you're in a business without those excess returns. So when you compute, and that's one reason I'd be a little cautious when you compute optimal debt ratios for companies, not to jump on companies that look under-levered right off the top. So you guys should be borrowing money. Check to see whether they're one of these companies that should be holding back. An Apple should stay under-levered. A Google should stay under-levered because in a sense they're in unpredictable businesses with huge excess returns. They're self-capital constrained. You're right. That's a constraint they impose on themselves because they don't want to go out and raise fresh equity. But it is something that factors into why technology companies will stay under-levered, and it's a rational thing to do. Any questions on the value of financial flexibility?
Yeah, can you just mechanically walk through how you come up with the capital fix or internal?
So basically what I do is I take capex, depreciation, and working capital over the last 5 years. I compute that and divide by firm value every year. So think of an Excel spreadsheet. I go back and collect capex 5 years ago, 4 years ago, 3 years ago, depreciation. So the reinvestment part, I compute every year. I divide by the enterprise value each year, which changes year to year. For the internal financing, I look at what's left over after dividends and interest expenses, the free cash flow to the firm, and I look at that number over the last 5 years.
So this is basically free cash flow to equity?
Which is, yeah, free cash flow to equity because you have, that's what you will draw on. So basically you can compute the free cash flow to equity every year for 5 years, take the average of the value each year and that average over time. For the first number, the reinvestment, I also compute the standard deviation in those numbers across time. That's what the 0.375 is. So everything comes from historical data, capex, depreciation, working capital, free cash flow to equity, and the enterprise value each year computed as percentages. You know what made the reinvestment rate so high for Disney in 97? In 96, they did the Cap Cities acquisition. It shows up as a big reinvestment. So companies that grow through acquisitions actually should value financial flexibility more than companies that grow with internal investments because acquisitions by their very nature are more unpredictable than internal investments. So it's kind of it's an interesting way to think about why some companies would choose not to borrow. It's not because they're being irrational or they can't see what's out there at that optimal debt ratio. It's because they value the flexibility to be able to take that investment of a lifetime if it comes along. Okay? Which brings me to the final piece of this section. When we think about equity in a traditional discounted cash flow model, we value it as a going concern. We value the company as a going concern. We subtract out the debt. We come up with the value of equity, right? But let's play a different game. Let's assume you're equity investors in a company and you're lenders to the same company. Equity investors get to run the company, right? You also get a residual claim, which means you get whatever's left over after the lenders have been paid off. And can you liquidate the company, shut down the company anytime you want? As equity investors, you can say, I'm done. So you get the right to liquidate the company at any time in time. And if what you get in liquidation is less than what you owe, if it's a publicly traded company, you know what you draw on? You have limited liability. What that means is those lenders can't come after your personal assets if the value of the assets is less than the outstanding debt. It's the fact that you have a residual claim, that you can liquidate the company at any time, and you have limited liability. Those three things come together to make your claim look like a call option. Let me back up. Okay? Think about running a company. Let's assume that you can liquidate the company. If you liquidate the company and the value of the assets is greater than the face value of the debt, you get to keep the difference. If it's not, then you lose what you originally paid for your equity, but because of limited liability, that's the limited, you can't lose more than that. That looks like a call option. What's the underlying asset here? It's those assets. If the value of the firm in liquidation becomes becomes the underlying asset, the strike price becomes the debt you owe, and the life of the option is actually the remaining life of your debt, because when your debt comes due, this is no longer your choice, right? Because the lenders can then decide to push you into bankruptcy, but until the debt comes due, you run the company. Let's cut past the abstractions. I'm going to use a very abstract example, but it's an example that actually brings home why this is an option worth thinking about. Let's assume, so you guys play the role of equity investors, you're going to be lenders to this company. Okay? The company itself has assets worth $100 million right now. So if you liquidated the company right now, it would be $100 million, and the standard deviation in that value is 40%. The lenders have lent money to the firm. It's a 10-year zero coupon bond. In a minute I'll explain why to make it a zero coupon bond with a face value of $80 million. So you guys have lent money to the company. It's a 10-year zero coupon bond, face value of $80 million. The 10-year T-bond rate is 10% today. I'm going to argue with that information, you should be able to tell me how much the equity in this company is worth, how much your equity is worth, and you should be able to tell me what a fair market interest rate on your debt should be. I haven't given you betas, cash flows, ratings, nothing. And here's why you're going to be able to do it. Think of your claim as a call option, right? Here's what the features of your option will look like. The value of the underlying asset is what you will get in liquidation. Today that number is $100 million, that becomes the S in the model. The strike price is the debt that you owe. So if you liquidate the firm at any time, you got to pay the lenders and you got to pay them the entire face value, which is $80 million, so that becomes the strike price. The life of the option is 10 years because it's a 10-year bond. Do you see why I made it a zero coupon bond? Because that means for the next 9 years and 364 days, you as the equity investors are untouchable. The lender doesn't have a claim coming due. If it were a regular bond, every 6 months you have interest payments due, right? Which shifts the power back to you. In fact, if you have a regular bond, it doesn't change the optionality, but you have 20 options piled on top of each other. 6-month option with another 6-month option with another 6. So to keep things simple, I've made it a zero coupon bond. We'll have to come back and grapple with that. But for the next 10 years, you get to run the company. Yeah.
Would you throw a default probability term in there?
We will actually estimate the default probability from these numbers. I think you can actually back it out from the standard deviation. You actually don't have to estimate the default probability. And that's one of the great things about using an option model, is one of the output pieces is actually the default probability. Okay? So basically what I have here is you guys run the company. Right now it doesn't make sense for you to liquidate the company because there's a time premium on your option, but you can liquidate it any time over the next 10 years. The value of the firm, the variance is 0.16, so it could go to 20, in which case you're bankrupt. It could go to 180, in which case as an equity investor you will never liquidate, and the risk-free rate is 10%. So I have all the inputs I need, S, K, R, T, and sigma. I plug the numbers in. I get D1, D2. Let me pause that. What does N of D2 give me again? What? That's a probability that? It's in the money. What does that mean here? What, in the money, the S is greater than K. What's S here? It's a value of the underlying assets. K is face value of the debt. There's a 63% chance that the value of the assets will exceed the face value of the debt. You say, where's this even going? There's a 37% chance that the value of the assets will be less than the debt outstanding. What does that measure? What happens when the value of your assets is less than what you owe? You're bankrupt. There's a 37% chance of default. There's an outfit on the West Coast called KMV. Here's what they do. If you're a bank and you have a loan portfolio, you can take your loan portfolio to KMV, and for a hefty fee, they will give you the probability of default on that loan portfolio. You know how they estimate it? They run it through an option pricing model. They come up with an N of D2. They take 1 minus N of D2. They have, they have lots of layers of sophistication they've built in, but that's effectively what they're doing, is they're using the option pricing model to estimate the probability of default. About 5 years ago, I was asked to review a paper that somebody had written on this, and what the researcher had done was he compared the probabilities from this model to the properties coming from using the rating for a company to see which ones predicted default better, and he found an option pricing model predicted default better than looking at S&P or Moody's and looking at the ratings that they attached. So there's a 37% chance of default, and it's built into the model. The value that I get for the call option is 75.94 million. You know what that 75.94 million measures? That's the value of your equity, because you have the call option. If that's the value of the equity, the debt has to be whatever's left over, right? 100 minus 75.94 is 24.06 million. And it's a zero coupon bond. So if it's a zero coupon bond, the face value of the bond is 80 million and the value today is 24.06. I can back out from that what the interest rate on the bond should be. In this case, that works out to 12.77%. The default spread is 2.77% over the risk-free rate. Yep.
Two questions.
Mm-hmm.
Could you use this approach for a private firm?
Absolutely. But I'll tell you what makes it more messy. The starting number was what? The value of the underlying assets, right? If you have that, then you can use it anywhere. With a private firm, there's no cheating. Cheating in the sense you can't look at the market value of the company. You actually have to do a traditional discounted cash flow valuation. That will become the S in the model, is the value that you get for the operating assets. Okay?
So it's tough if you're running the private company in distress.
No, the assets, because the distress part comes from the debt, right? So you could do something as simple as, if you know what the EBITDA is for the private company, let's say that companies in the sector trade at 6 times EBITDA, you can take 6 times EBITDA, make that your S in the model. The debt is the problem in the private company. It's going to be a big number. It could be even higher than the S, which means in your traditional DCF valuation, you'd have attached no value to the company. But if that debt is long term, there can still be optionality in the private company. So that's basically where we're going with this, is the discounted cash flow valuation becomes the input into an option pricing model. And this is actually what some of you will have to do, because some of you in your original DCF valuations of your companies came up with the value for the operating assets that was less than your debt outstanding. And at that stage you say, what do I do? My value of equity is minus $21. On a DCF basis it is, but if there's long-term debt, there can be still optionality in this process. You had 2 questions, you said. Forget the second question? Okay. So any questions on that? Basically, the equity investors get the call option. The call option is worth 75.94. The debt is worth 24.06. We're done, right? I'm going to use this very simplistic example to kind of debunk some things we took for granted in corporate finance. Let's assume that you buy the equity in the company and you paid 75.94 million. Tomorrow morning you wake up to some really bad news. Half the company has disappeared. Don't ask me how. There were 2 factories, one in Miami, one in Los Angeles. Take your pick. Hurricane, earthquake, it's gone. Uninsured. Good news or bad news for you as equity investors? Unless you have a very perverse sense of good news, this is terrible news, right? Half the company's disappeared. The value's gone from 100 to 50 million. But here's my question. It's a very practical question. Remember your value yesterday was 75.94 million? Now I've wiped out 50 million, right? The question is, what is the value of your equity going to be now that half the company has disappeared? And I'll give you the choices. Maybe it'll drop by 50 million. 75.94 minus 50 is 25.94. Maybe your accountants will tell you at this point your book value of equity is turned negative, you should declare bankruptcy, the equity could be worth nothing. Or maybe the equity will drop, but not by as much as 50 million. See the choices? It drops by 50 million, more than 50 million, or less than 50 million. What do you think will happen to the value of your equity? It'll be worth more than 25, right? Which means that it'll drop by less than 50 million. If it drops by less than 50 million though, who's the other player in this game? The 50 million has to be borne by somebody, right? So the equity investors say, we're bearing only 45 million. Who's bearing the remaining 5 million? The debt holders. Do you think they want to do this? They say, no, please keep it. But you know what? You're going to get sucked into this process, and let's see this play out in an option pricing model. So tomorrow, if I write the option pricing model, here's what it's going to look like. My S is going to be 50 million. It went from 100 to 50. Half the company is gone. My K stays at 80 million. I still owe the 80 million. I still have roughly 9 years and 364 days, but let's round it up to 10. The variance stays unchanged. How can that be? Variances are percentage value. So if I slice the company, I've one factory instead of two. The expected cash flows might be half what they were before, but the variance as a percentage variation doesn't change. So it's still 0.16. And my risk-free rate is 10%. So I want you to remember what your equity was worth. It was 75.94 before, and your debt was worth 24.06. Let's see what happens to those two values now that I've thrown this catastrophe into the mix. First, I do N of D1 and N of D2. Let me pause right there. What was the probability of bankruptcy before this happened? 37%. What's the probability of bankruptcy now? It's about 59% or 58.5%. No surprise there. Half the company disappears. Of course, your probability of bankruptcy went down. The value of the equity was 75.94. It's now 30.44 million. You've lost $45.5 million in equity value, which is to be expected. This is a bad event. The lenders were 24.06, now have seen their value drop by 4.5 million, which means the interest rate on your bonds is going to jump to about 14 or 15%, reflecting the higher default risk. So if I drop the value by 50%, your value of equity drops by less than 50 million because the lenders bear some of this cost. So once I got started on this path, I couldn't stop. What I mean by that is I said, what will happen if I drop the value to 40 or 30 or 20 or 10? You know what I was trying to find out? When does equity become worthless? When does the equity value go to zero? And you know what? I dropped the value to 5 million, 3 million, 2 million. The equity hung in there. It's an incredibly stubborn instrument. So here's my question. If the value of the assets is 3 million, now, 80 million, why does equity hang in there? What gives it value? If everybody can look at the company and say, this is a basket case company, this is crazy, how come the equity still hangs in there? What's keeping it up? Yeah. It's a hope and a prayer. Right? Basically, you're holding on and hoping and praying, and you have 10 years to hope and pray. It's amazing. If you have time on your side, equity will continue to have value. This is actually the explanation to that puzzle. Sometimes you'll see a company that you're hearing terrible things about. You look at their financials, they're horrible, but their shares will still trade 20 cents, 15 cents. And if you buy those shares, think of why you're buying them. Are you buying them for the dividends? I hope not. Are you buying them for the cash flows? Not unless you like big negative cash flows. You're buying them for the same reasons you buy deep out of the money options. And remember what happens to most deep out of the money options. They end up in the trash can. That's okay, because when they pay off big time. That Las Vegas Sands shares, which were down to $7, $6, $5, $4 in 2009, if you'd bought them then, you were buying out of the money options. And guess what? Those shares are now worth $65 or $70 per share. Your option paid off big time. If you bought Continental Airlines in 1992, you got it at 50 cents a share. 5 years later, you'd have sold it for $19 per share. When you think about vulture investing from an equity perspective, this is what you're buying. You're buying huge bunches of out-of-the-money options. They don't all have to pay off. In fact, most of them don't have to pay off. The ones that pay off have to pay off big time to cover the ones you lose. But it changes the way you think about investing because you're buying options now. And we'll talk about what kinds of companies you go looking at. But that's basically an indication of why equity hangs in there. In fact, it gives you a very different perspective on what it means to go bankrupt. I used to think that going bankrupt meant that the value of your assets was less than the value of your outstanding debt until about 16 years ago, 17 years ago, because my daughter just had her 20th birthday. So when she was 3, it was summer, and I used to play Monopoly with my sons, my older sons, and my 3-year-old daughter would insist on joining in. She's very persistent. So I said, finally, Kendra, you can join in. And after 2 games, I had to banish her because she's like a one-person Enron. She would collect $200 no matter where she was in the board, put up hotels and properties that didn't belong to her and charge you like Donald Trump. It's not she'd put a big hotel right in there. She'd put hotels in train stations. So you pass, give me 200, like the extortionist. So finally, after 2 games, I said, Kendra, you're banished. Tiny person, horrible temper. She starts walking around saying, you're bankrupt, you're bankrupt, you're bankrupt. I'm very impressed that a 3-year-old is using the word bankrupt. So I said, Kendra, what does it mean? Expecting an answer like the value of your assets is less than the value of your outstanding liabilities. She said, bankrupt means you don't get to play the game anymore. You know what? That's the perfect definition of bankruptcy. That's why I'm not bankrupt here, because I get to play the game for another 10 years. And as long as I get to play the game, I am not bankrupt. So when you think about equity in these deeply troubled firms, you've got to change your mindset. You're not thinking of cash flows and going concerns value. You're thinking about deep out of the money options. In fact, let me use that example to kind of bring home a second point. Yeah.
Isn't it different in like a normal firm, just because here we're assuming is that these are zero coupon bonds, but if you have interest payments coming due, like
It doesn't change your thinking. It just means you have a series of options you got to live through, right? So basically, it's 20 options piled up. It makes the pricing more difficult, because the second option has value only if you live through the first option. So you almost have to value them sequentially.
right.
Okay? So mechanically it's more complicated, but the thought process is exactly the same. It still stays an option. Everything you say about a zero coupon option applies when you have these 20 options piled on top of each other. Exactly. Now let's use this to look at another issue that comes up in corporate finance. In corporate finance we talk about agency problems, especially when you talk about capital structure. You know what agency problems are? That what's good for equity investors and what's good for lenders can be very different. So to illustrate that, let me use a simple example. Let's go back to the original company before the catastrophe. Remember, $100 million asset value, equity was worth 75.94, debt was worth 24.06. I'm a project salesperson. I show up in your offices and I try to sell you a project. I say, do I have a project for you? You're a corporate finance person. You say, what's the net present value? Minus $2 million. Already you're getting ready to throw me out of your office because you remember your corporate finance. Bad project, negative net present value. I said, no, wait. Not only is it a bad project, it's a very risky project. This is going from bad to worse, right? What happens if you take a bad, very risky project in corporate finance? The value drops. But here's one of the magic things that's going to happen when you start thinking from an option standpoint. Let's say you go out and you take this project. The standard deviation is very high. The net present value is negative. Here's what your option is going to look like. So I want you to remember what your equity is worth now before you take this bad, risky project. And remember, you're the guy, the equity investor is deciding. First, the value of your business is going to drop by $2 million. Why? Because you took a negative net present value project. It's corporate finance 101. The face value of the debt stays the same. The life of the option stays the same. But now your variance for the combined firm jumps because you took a risky project. Let's see what the value of your equity is now that you've taken this bad, risky project. Now revalue your equity. Here's what I get. Remember the 75.94 million before you took this bad, risky project? Now that you've taken a bad, risky project, the value of your equity jumps to 77.71 million. How the heck does that happen? Who's the big loser here? The lender basically is subsidizing you. And especially as you get to very highly levered firms, you know what this is telling you, right? If you let the equity investors pick projects, they can take you as the lender to the cleaners, because essentially they're going to take riskier and riskier and riskier projects. Because if you're going to go bankrupt, what difference does it make if you go bankrupt owing 200 million or 800 million? It's like, I mean, the closest analogy I can think is you go to a casino, Atlantic City. You lose your entire wealth. You gamble away your house. The casino lends you $200,000. You have two choices. You can gamble really carefully. You're already bankrupt. But now that you have $200,000 in the casino, you can either gamble very carefully with the $200,000, or you take the $200,000 and you put it down on number 23. Number 23 doesn't come in. What difference does it make? You were already bankrupt. You walk away. Number 23 comes in. You're out of the hole right away. That's exactly what happens with highly levered firms. Is the equity investors have so little to lose that they keep taking riskier and riskier investments. Which means if you're a lender to a highly levered firm, you know the lesson you get out of this is? Don't let the equity investors run the company unfettered. I mean, that's why when banks complain about bad things happening to them in LBOs, I say, what did you expect? You lend money to an equity investor who's highly levered, and you expect him to do the right thing. He's doing the right thing for himself. He's not going to do the right thing for you. You've got to stay involved if you're lending to a levered firm. So if you're a vulture investor investing in bonds, that's something you need to think about is if you're buying bonds in deeply distressed companies, you want to make sure you have a role in how these companies get run, because if you don't, you're going to get destroyed. Let's do one final example to kind of use this simple case. Let's say that you're the manager of this firm, and manager of any firm, and I come to you with a target company you can acquire. So I've done a valuation of this target company. And I come up with a $150 million value, and I say you can buy the company for $150 million. Let's assume that I'm not a first boss who screwed up the numbers. This value is actually the correct value, and you can get it at fair value. Again, go back to Corporate Finance 101. If you take a fair value investment, what should happen to your value as a company? Nothing. It's like a zero net present value, right? But let me put some flesh on this $150 million investment. Let me put you back into that original company you were investors in. Remember the $100 million company where your equity was worth 75.94? Let's assume the company you're acquiring, the $150 million company, comes with its own debt of $50 million and is in a different business than the company you're in. You're saying, what does that matter? Well, because they're in a different business, the correlation between the two companies is less than 1. Let's say it's 0.4. So the companies don't move together. Let's see what the effect of that is going to be on your value. So you did a fair value acquisition. Let's see if you as equity investors in the acquiring company come out of the game made whole. So you combine the two companies, right? So the combined company's value is going to be $250 million, 100 plus 150. The standard deviations of the two companies were 40 and 50%. I combined the two companies. What's the standard deviation of the combined company going to be? Lower. It's not going to be between 40 and 50. Why not? Because remember, portfolio theory 101, you combine two assets which have a correlation of 0.4 with each other. The combined company's portfolio, I know this looks really messy, but it's actually the first thing you learn in foundations when you do this two asset. That's just the standard deviation of a two asset portfolio. Two companies. The first term is firm A. The second term is firm B. The third term is the covariance term between the two. But the bottom line is by combining the two companies, the variance that you get is actually lower than the variance of the two companies that went into the mix. Saying, so what? Why is that going to affect you as the equity investor? It's bad for option value. In other words, the variance goes down and you pay the same interest rate you did before. Here's what happens. The combined firm's equity value, even though you paid a fair price on this acquisition, is going to be roughly $3 million less than it was before you did the acquisition, because you're transferring wealth from yourself as the equity investors to the lenders in these two firms. Practically, why are the lenders happy about this acquisition? You had two separate companies before, right? You lent money at a fair market interest rate to these two companies until yesterday. They were both risky companies. You set an interest rate based on that risk. Now they've become a combined safer company, and if I don't renegotiate the interest rate, guess what? You've got a subsidy. Your market value of debt will increase at the expense of the equity investors. This happens in conglomerate acquisitions all the time, right? Because you go into multiple businesses, this is almost guaranteed to happen. Is there a way you as equity investors can counter that? What can you do to get to claw some of that value back? First is you can try to renegotiate the interest rate with the lenders, right? After this, you say, look, this is a combined company. I'm not paying you what I did. Let's say the bankers refuse. They've got the contractual agreement. They look through the fine print. No, we can't. You can't do that. I can still get at them, right? And here's how. I decide how I'm going to finance this acquisition. So what should I do if it's a conglomerate acquisition to kind of counter this transfer of wealth? I should go out and borrow a lot more money, because by borrowing money, I'm effectively getting that wealth back. Because by borrowing money, I'll make the company risky enough that the old interest rate is now a fair interest rate. So if you're going to create a conglomerate, this actually gives you a framework for doing it. Go out and buy companies and other businesses Increase your debt ratio as you go along, because if you don't increase your debt ratio, the equity investors in your company will be worse off at the end of this process, even if you get these target companies at fair value. So it's actually amazing how that's a very simplistic example with zero coupon bonds, how many different implications you can get out of it just by playing with the numbers, seeing what the effect is. Okay? Yes, Joseph?
Is this method useful for finding the market value of debt at all?
You could see if you have the value of the assets. That's what makes this all work, right? I started with 100 million as a given. If I know the value of the assets, then all I have to do is decide who gets what.
Right.
So I can get the market value of debt, I can get the market value of equity, but it all is only as good as 100 million that I fed into it. So it looks deceptively precise because the starting number was given.
But you're assuming that you already have the value of the firm.
Exactly, the value of the assets. And that's what I'm going to wrestle with next is, if I came to you with a real trouble company, how would you get these inputs? Because no real trouble company has one nice zero coupon bond outstanding, right? Because they borrow from everybody and their brother. No trouble company, it's not easy to get the value there. Forget about private companies, even public companies, if you're in trouble, it's tough to get the value of the assets. But are there any questions on the mechanics of what we've done before I look at trying to apply it for a real company? Any question? Yeah.
Just one curiosity, I guess.
Yeah.
This is looking at option valuation. But if you go back to say DCF, wouldn't it lower your cost of capital to make the firm safer? Because your beta would decrease and the cost of equity would decrease.
The beta will not decrease. You know why?
Wouldn't you be?
Yeah, because this drop in variance is happening. Why? Because you're getting rid of firm-specific risk. The market risk doesn't change. So beta cannot go down from creating a conglomerate because it's always going to be a weighted average. So that's why you don't get a benefit from doing this, because you're already priced on the basis of only the risk I cannot diversify away. Right? So let's talk about how we can extend this very simplistic example to a real company. So I'll make some confessions up front. The example I created was incredibly unrealistic. And here's why. There were only two claim holders in this company, the equity investors and the lenders. Saying as opposed to one, if you look at troubled companies, there's senior debt, there's secured debt, there's subordinated debt, there's leaseholders, there's equity investors, there's internal equity, it's like a crowd of people each fighting for their estate. So I made life simple. There's debt and equity. Second, there was only one debt issue outstanding. It was a nice 10-year zero coupon bond. And as I said, that's incredibly unrealistic. Third, I gave you the value of the firm and the variance in that value. So if I came to you with a real company, don't expect all those inputs lined up in front of you. In fact, none of them are going to be lined up. Let's talk about how we'd estimate these numbers. So here are some suggestions, and you can decide which ones work for you. So I'll give you multiple suggestions in each one. First, for the value of the firm. If it's publicly traded, you can cheat. You can cheat in what sense? You can take the market value of equity plus the market value of debt and call it the value of the firm. You know why that's cheating? You add them up, you get a value for the firm, then you break them up again and you come up with different values. It's like magic that you're doing. So that's if you're lazy and you want to do this. Here's my suggestion. Value the assets of the firm using a discounted cash flow model. Just value the assets. Forget about the debt, forget about all. In fact, I'll go further. Value the assets of the firm as if this were a healthy company. Because if you try to use its existing cost of capital with strange debt ratios, who knows what you get. Value the assets of the firm to a healthy buyer, which might involve using a cost of capital of a typical company in the sector, or if you don't have the time, apply a multiple of EBITDA or revenues of healthy companies in the sector and say, this is what a healthy telecom company, a healthy steel company would trade for. Use that as value. Once in a while you might get lucky. If you have 6 radio stations and that's what your company is, and those radio stations are in markets where you can buy and sell them, you can add up the values, and or real estate, you can add up the value and say that's the value of my asset. So that's my starting point. I can get there one way or the other. The variance is trickier, right? If it's publicly traded, again, I can try to back out the variance from market prices. The only problem is if you have a troubled company, market prices are going to be crazy. Stock prices are going to jump up and down. Who knows what's driving the prices? So I'll give you a lazy way out. And this is what I do. I have a troubled steel company. You know what I use as my standard deviation and variance? What I did for bottom-up betas. I look at the betas of steel companies. I look at the variance of steel companies. fact, you go to my website, I report variances in firm value by sector. So you tell me what sector you're in. I'll say this is what typically is the variance in firm values of companies in this sector. So you can try to back out the variance from stock prices and bond prices for your company. You can look at sector averages. Or if you want to get really fancy, you can pull up crystal ball. Remember, we did a discounted cash flow valuation, right? So if you make that a simulation, you can actually get a standard deviation in that value. That becomes the variance. So I've got the value of the assets, I've got the variance in that value. Now let's talk about what to do about all that messy debt you have. I'd love it if you had one zero coupon bond, but I know you're not. So here's what I'm going to do. I'm going to take all your debt, bundle it together, and replace it with an equivalent zero coupon bond. Sounds fancy, right? Let's say you have 15 different debt issues. I take everything you owe, add them all up, and treat that as a face value of the zero coupon. Then I take a weighted average of the duration of your 15 debt issues. Because remember, duration is the equivalent maturity of a zero coupon. And I said the weighted duration of your debt is 7 years. I'm going to act like you have one big zero coupon bond with a maturity of 7 years and the face value equal to all of the debt. I know I'm cheating. And that's why purists never really are able to work on option pricing. Because if you're a purist, no way can you do that. I say, yes way I can do that. Because if I don't do that, I can't value companies. So I replace my debt with one big zero coupon bond. So ready? Let's try this. I'm going to try this on Eurotunnel. You guys familiar with Eurotunnel? It's that hole in the ground where cash goes in but doesn't seem to come out. It was built with a lot of hope, right? When it was built, it was supposed to bring revenues to Britain and France from people going through the tunnel, but it's never made money. And I took it at one of its darkest moments. This was in 1997. Eurotunnel had operating losses of 56 million pounds and net income of minus 685 million pounds. Its book equity was negative. That tells you that it's not just losing money, but it's been losing money for a really long time. And there's no light at the end of the tunnel. I hate to use that word here. There's really no light. It's like a train coming at you if it's a light. So clearly, this is exactly the kind of company this was designed for, right? It's a company with big losses that expects to make big losses in the future. Here's the second piece of the puzzle. They owe a ton of money. 8.9 billion pounds of debt outstanding, all kinds of debt, short-term, 10-year, 20-year, longer. The weighted duration of their debt is 10.93 years. And the total debt they owe is 8,865. Now you see the sleight of hand I'm going to do? I know they're very messy debt. I'm going to replace all their debt with one zero coupon bond with a duration of 10.93 years and a face value of 8,865. What's the final piece that I have to do? I have to get a value for the assets, right? I did a conventional discounted cash flow valuation. I dug them out of the hole. I gave them healthy margins. I gave them a regular cost of capital. The value that I got for the operating assets, assuming that things work out, is 2.3 billion pounds. How much do they owe? 8.9 billion pounds. My discounted cash flow valuation is 2.3 billion pounds. If I were doing a DCF, I say, you know what, the equity is worth nothing. And you're right, from a DCF perspective, it's worth nothing. But the debt is really long term. 10.93 year duration. So here's what I'm going to do. Last piece, I'm going to compute the variance in that 2.3 because that 2.3 is stuck at 2.3. I'm dead. I want that 2.3 to move around. So I took a look at stock prices for Eurotunnel and bond prices. You're saying, why don't you look up sectors? This is one of the few cases where I could not find a sector because in 97 actually there were no publicly traded toll roads. Today I have a chart. There are globally especially you can get publicly traded toll roads in other companies, but those days I did not. So I basically took the debt ratio, which is 85%. I took the standard deviation of the stock price and the standard deviation of the bond price and thought about buying a portfolio of stocks and bonds in the company. I want a variance in firm value, not equity value. And I came up with 0.0335. I'm almost home. I have everything I need. I plug the numbers in. Value of the underlying asset is 2.3 billion pounds. Face value of the debt is 8.9 billion pounds. The life of the option is 10.93 years. Variance is 0.0335 and the riskless rate is 6%. I plug the numbers in D1, D2, N of D1, N of D2. What's the probability that Eurotunnel will go bankrupt? 92.5%. No surprise here, right? But here's the miracle. This is a complete disaster as a company. But look at that. Value of equity hangs in there, 122 million pounds. And it hangs in there because the debt is really long term and you're hoping and praying that something good will happen and you have time as your ally. I don't use this option pricing approach frequently. I use it when I get desperate. You ask me to value an airline, I'm usually going to get desperate really soon. Right? If you look at airlines, especially in bad times, it's very difficult to get the value of their underlying assets above the value of their debt. When I was trying to value Petrobras, I got desperate because at today's oil prices, it's very difficult to get a value for Petrobras that exceeds 135 billion. But if you think about it as an option, it changes your perspective, right? It essentially gives you an explanation as to why you might buy equity in a deeply troubled company. But you have to walk in with open eyes. You're buying an out-of-the-money option. And that out-of-the-money option has to be thought about like an option. And let me explain what I mean by that. Let's say you decide that based on this you want to become a vulture investor. You want to invest in equities of deeply troubled companies. So I'm going to give you some choices on what kinds of companies you'd like to focus on. Do you want to buy equity in deeply troubled companies in stable sectors or deeply troubled companies in volatile sectors? What does that even mean if I say you have a deeply troubled stable company? Basically means you lost a lot of money. I can guarantee you lose exactly that money essentially in perpetuity. Who cares, right? If you're deeply troubled, you want risk as your ally. So you've got to have that mindset of saying, I'm buying an option, I want uncertainty, so I'm going to buy deeply troubled semiconductor companies, not deeply troubled utilities. Let me ask you a second question. Are you going to buy equity in deeply troubled companies with short-term debt or long-term debt? I want long-term debt. So you want to buy equity in deeply troubled companies with long-term debt. Why? Because you're buying an option. And one of the nice things about buying an option in Eurotunnel is when that debt comes due from a French bank especially, you know what the French government does? It puts pressure on the bank to extend the loan. It's like having an option where somebody keeps extending the life of the option for you. But it's a different way of thinking about investing in equity, but that's basically what I want you to think about when you think about the equity in the next distressed company you look at. Yeah.
This is all fine and everything, but the problem is you're valuing everything as a real option. The market's valuing everything not that way.
That's not true. In fact, there are studies that look at price-to-book ratios of very, very deep underwater companies. And you often see that if you look at those price-to-book ratios, especially as you get to high debt ratios, you find the price-to-book ratios are higher. I mean, the market will attach a low price. It's not that it's going to attach a high price to any of these companies. It's a low price relative to book value. These companies, I mean, Petrobras, for instance, looks cheap on an EV to EBITDA basis. But if you do a DCF valuation, it looks like you will never buy the equity. But if you think about it as an option, you might still buy the equity because of the uncertainty around the value. So in fact, the market is valuing Petrobras at a number that you cannot justify with a DCF valuation. Now, whether you're willing to pay that much for the option then becomes a question. It's how much is the option worth? And that might rest on what you think about oil prices and uncertainty about oil prices more than what you think about Petrobras as a company.
So you have to compare what you get with the option value with like things that are realistic.
In fact, you could argue that every publicly traded company is a going concern value and an option value. The option value is an option to liquidate. For most healthy companies, the going concern value is going to be higher than the option value. But for some companies, the option, so it's actually, the general rule is every company has an option value, a liquidation value, and a going concern value. The highest of those three numbers is what you'd attach to the company. In DCF valuation, we're always going with a going concern value. And I'm saying sometimes that going concern value will get displaced, either by an immediate liquidation value or by an option value. And you've got to think about the highest of those values as the maximum you're willing to pay. I'm not saying you should go out and pay 116 million for Eurotunnel. You like to buy it at 35 or 40 million. But even at 35 or 40 million, people might think that you're overpaying because on a traditional DCF basis, it'll look like you're overpaying. But it's the option you're getting. Yes?
So, in terms of the debt, what if you have like a high standard deviation of your debt, and that you have like 50% of that $8 billion or $9 billion worth of debt, like it's due in a year, the duration is about a
You know what, if you want to be conservative, that's actually a very good question. If a large portion of your debt is due in the short term, first, the life of the option will get much shorter, right? It's a weighted average. So basically the weighted duration will become 1.8 years rather
I'm
than,
saying, like, what if the duration for one is like 1 year, and then the
you have a
duration for the
100-year,
other half
then
is
just
like
take the
2
1-year
years?
debt.
Okay.
Did everybody get this question? What if you have 50 billion in 1-year debt and 50 billion in 100-year debt? No, it's a very extreme example. If you take the average, you get this really long duration. You put that really long duration, you get this huge option value. Don't pay it because you got to get through that 1-year hurdle where a lot of the debt comes due. So that's a scenario where I might say, look, a lot of my debt is coming due in 6 months or 9 months or a year. I'm going to act like that's the life of my option, because if I don't get over that hump, I'm not going to make it.
Okay.
Right? So I think there are ways in which you can adapt the model to reflect what you think is reasonable. Right? Because the other issue is the legal tangle you get into, right? Which is once you get into Chapter 11, you can't really value equity as an option anymore because the optionality gets taken away. You don't get to decide how the companies run anymore. The courts get to decide. And that basically starts to take the optionality away. So all those things have to be factored in when you think about what kinds of companies. In fact, here's a screen you can run. What you want are companies that are losing a lot of money. Maybe look for negative book equity because then they'll be losing money for a long time. Look for high standard deviation because they're risky. And look for a lot of debt. It's a very perverse way to look for companies because that's not normally what we look for. But you get a list of companies which owe a lot of money, are losing money, and you might say, look, let's see what the share's trading at. Maybe I'll be able to get those options at below fair value. It's a different way of thinking about investing in stocks than your traditional, let's go for cash flows, earnings, growth. I'm not saying one is better than the other, they're just different. So Sam Zell says, this is how I invest. Who am I to say, yeah, that doesn't sound like good investing. He's made a lot of money doing it, right? So if that's what works for you, and you can, and that's your competitive advantage, is you can gauge where equity in a distressed company is most likely to be most valuable. This is one framework that you can use to get there. Okay. Any other questions? Okay. So if you think about everything we've done in option value, let's review. There are options everywhere. Let's concede that. Right? Most of those options have very little economic value. Don't waste your time on them. That exclusivity test comes in. If your options have economic value, then using an option pricing model requires replication and arbitrage, which means that you've got to be very careful with the numbers you get from option pricing models on many of these real options. But here's what I want you to take out of this section, even if you're not comfortable using Black-Scholes or binomial models. What I want you to take out of this section is the insight you get about what happens when you think about something as an option. That risk now is your ally, not your enemy. That you want to seek out uncertainty, not avoid it. Because that's critical to understanding how to deal with options. Okay. Monday session, we're going to start, we're going to do acquisitions, just one session. Because that's all you really need. We've actually laid the foundation of valuing a company in an acquisition, but I'm going to talk about control and synergy and some of those things that are specific to acquisitions. I'm going to send you, instead of a start of the class test, I'm going to send you the test the previous day. It's like 7 short questions. If you get a chance, please go through those 7 questions. It won't take you more than 5 or 6 minutes to go through the entire section, because it'll give you a framework for what we're going to talk about on Monday. And on Wednesday, we're going to finish the process by talking about how do you change value at a company. What are the levers you have on changing value? Incidentally, if you haven't looked at my blog, I just posted on valuing a CEO, because right now we get all these news stories about Target CEOs paying $28 million. GoPro's CEO got paid, what, $284 million? So the question, of course, is he worth 284? Is he worth 28? So I actually have I've actually a spreadsheet where I took the simple Ginzu spreadsheet and I tweaked it to make it a spreadsheet to value a CEO. Take a look at it, because I valued Satya Nadella at Microsoft using the spreadsheet, because I'm a Microsoft stockholder still. Because Satya Nadella was the highest paid CEO last year at $84 million. The question is now, can you justify $84 million for a CEO? And don't prejudge, because I walked in with a completely open slate, because I don't have good feelings or bad feelings about Satya Nadella, but based on the numbers, you might be surprised at what you get. So you get a chance, take a look at that blog post as well, because it will give you a framework of thinking about how much a CEO is worth. That's it. I'll see you on Monday.
I was just gonna ask by the 11th of May if we're gonna have something. We're gonna have something on the 11th. Because the final is
Then see, there's no reason why you should have your portfolio. Alright, I'll see you. Adios.